Thanks, Marty. Welcome, everyone. Thanks for joining us for the final program of the day. My name's Jim Bowles. I've had over 30 years of experience in the asset management field, primarily on the new business and relationship management side. Most recently, I spent 3 years at Prana Investments, a firm focused on rent-stabilized multifamily. Prior to that, over 20 years at Common Fund, a nonprofit asset management shop. So we're gathering at a pivotal moment as interest rates expectations shift, inflation persists in pockets, and capital activity remains uncertain. Real estate investors, especially family offices, are confronting structural changes across property types, financing, and investor behaviors. So our panel brings together a uniquely qualified group of leaders to share perspectives on where we're headed in 2025 and how family offices can navigate it. So let me introduce the panelists. We're not in the right order.
No, we're not.
Okay.
Paul Sygrove.
Well, Paul's the Chief Investment Officer at Swig Equities, a privately held real estate investment and development firm with deep roots in New York City real estate. We have JanetLee Santiago. JanetLee is the Managing Director, Head of Capital Markets at DF Capital Management, a specialist investment manager focused on residential real estate and fully entitled residential land, providing finished lots to homeowners in a unique fund structure. Ron Davari. Ron is the Chief Executive Officer and co-founder of NewOak Capital, an investment manager and advisor in private credit, structured products, and complex asset strategies. Sam Zylberberg, thank you, is partner at Akerman, where he advises institutional investors and family offices on real estate transactions, structures, and risks. And Eric, who you just met a moment ago. So I would ask you guys each to take a couple of minutes to introduce yourself and what you're working on right now. We can start with Paul.
Sure.
Go on the line.
Swig Equities is a third-generation family office. We generally are looking for trophy type of properties, which are generally value added. We're not really necessarily looking at, shall we say, distressed properties. I mean, distress is very regional, and we have a very regional family office with the investments only in New York City, San Francisco to LA.
Great, thank you.
Thanks, Jim. DF Capital Management is, as Jim mentioned, a specialist investment manager covering the residential real estate space in single family homes. And what makes it unique, he had mentioned the fund structure, is that it is akin to asset-backed finance in that we own, and we'll get through this in the rest of the panel, but we actually own the land and receive contractual income. And so amongst family offices and sophisticated investors, although it's residential real estate, they tend to look at it more like asset-backed finance, credit, fixed income type structure.
Ron Davari, I'm the founder and CEO of NewOak Capital. NewOak Capital was born in the credit crisis. Previous to that, I founded and built out BlackRock's global structured finance that included real estate as a subset. But on the debt side of things, and during the credit crisis, NewOak was born to really try to figure out a new way to connect capital and opportunities in what I consider assets that were pretty much hung up in the banking system. And there was a big desire by the Fed and a lot of other governments to off-balance sheet that. That doesn't seem to change now. We're finding that opportunity is re-emerging again. But our specialty has been always as expert in bringing an asset, taking a look at it, taking a look at the future value. I normally call them undervalued assets as opposed to non-performing. A lot of reasons for it is the way it's structured capital-wise. If you unleash the potential of any asset, you would definitely maximize value. So we are a value maximizer. I finish up by saying that there's no single real estate asset. You just saw one example of it a minute ago. I can give you lectures on multiple ways of investing, including if you're interested to invest in a reappropriation of a battery technology to manufacture into the US. I don't know how many of you guys exposed to that. I assume very few of you. And that's really the opportunity said don't really look at real estate as one niche. If you're looking at different ways of deploying capital into real assets and operating assets, I think we at least should be one stop for you to show you things that you probably haven't seen.
Hello, everyone. I am Sam Zylberberg. I'm a partner in the real estate group at Akerman LLP. Akerman LLP is a 700-plus lawyer law firm with 24 offices around the United States. Akerman has 160 real estate lawyers and professionals in the group. I co-head the real estate finance group, which has approximately 50 professionals. I've been doing this for 37 years now. So I've been through multiple down cycles and seen a lot of what's out there in 37 years, including some of the very complex transactions, both in the distress arena and in just regular real estate. These days, and for a while I've known a lot in the debt equity spectrum, what I mean by that is representing mortgage borrowers and lenders in the mortgage lender space, in mezz loans, in preferred equity investments, and in equity investments. The kind of stuff that I'm seeing now, we are working on distress transactions, as you could imagine. Some distress, not a lot of distress. Doing a lot of construction transactions. And in the construction transactions, representing both the investors and the lenders, and we're doing some more niche stuff like workforce housing.
Thank you, Sam. Eric Metzger, again, just finished speaking a couple of minutes ago. I've been in the high-end luxury amenitized real estate space for about 27 years. All around the world, from Charleston and Hilton Head to Scottsdale to Tahoe. And then I've worked on projects with developments in Half Moon in Montego Bay, Jamaica, the Ocean Club in Paradise Island in the Bahamas. I was in Macau on the Cotai Strip in China with, as I mentioned before, with Sheldon Adelson and Las Vegas Sands. We're a unique bunch. We're not commercial real estate guys. We're not industrial real estate guys. We're not in manufacturing. We're not general real estate. We're literally wired in the high-end luxury destinations markets. And it's a robust market, I can tell you that. It's growing. And what I have found, though, in the last 10 years, the buyers are changing from the perspective of, instead of buying one single home as their second home, and they're only there 6 weeks a year, they'll buy multiple properties on a fractional basis or in a private resident club to have all those amenities, to be able to spend the time that they want with their family and friends, but not feel obligated to go to a second home 20 weeks a year when they only can make it 4 to 6 weeks a year. So that's a real shift in my space that I've seen. Truly over the last 10 years, we've seen that migration and shift to multiple properties versus one single second home.
Great. Well, let's go to some questions. Sam, why don't we start with you? As counsel to real estate investors, how are you seeing deal terms evolve in 2025, particularly in light of shifting rate environment and tighter capital markets?
So let me speak a little bit about the market, and then I could shift into that because the deal terms are a function of the market. So what I'm seeing in the market is, so take multifamilies, for example. Insurance expenses are going up, labor expenses are going up, and even in sort of the hot markets, like Dallas market and the Phoenix market, rents are sort of stabilizing. NOI is getting a little tougher, and that's happening to somewhat in the hotel market as well. Labor costs are going up, insurance is going up, so the NOI is getting squeezed there a little bit as well. In industrial space, with the tariffs, that's also affecting the industrial space to some degree. I mean, it's still a good space, but it's affecting it to some degree. And grocery anchored strip malls, they're doing pretty well. Probably of the retail space, they're probably doing the best. Office, as I'm sure many of you know, other than places like South Florida and, you know, the very top of the market in New York, which is doing reasonably well, and maybe Boston, you know, office is still having significant problems. Things are getting a little bit better, but, you know, they're still having significant problems, and data centers are just hitting it out of the park. With deep seek data centers had a bit of a hiccup, but data centers are still going, you know, full blown ahead. In the credit markets, you go back a year and a half or 2 years ago, the credit markets, I mean, there were lenders who were, you know, in the market actually doing deals. There were lenders in the market not doing deals, and then there were lenders out of the market. Most recently, there's been a lot of liquidity. There are private credit, you know, entering the market, and that private credit, there are about 350 private credit providers. And, you know, the CMBS market is, you know, it's active, and the life insurance company market is active. So all these players are active in the industry and competing against each other. Interest rates, you know, are getting squeezed because there's so much competition, but people are still doing good deals. I mean, it's not like you know, other distressed times when, you know, they were chasing deals and then they started going to deals that were more problematic. People are still looking for good deals. And so where are we right now? And this gets into the, you know, the change in terms. Where we are now is that these lenders have competed on interest rates, and now they're competing on other terms. And so what you'll find is that, you know, they'll be doing things like, you know, lowering the DSCR. They'll compete on DSCR. They'll debt service coverage ratio. And they'll compete on things like they would always want a warm body, non-recourse carve-out guarantor. Now, you know, I'm doing a deal where they're willing to accept a capitalized entity. So what you're seeing in the market now, as you know, as lenders, you know, they're still chasing good deals. There's a lot of money chasing the deals, especially in the private credit space. They're adjusting the you know, the financial tests and other provisions to compete against their peers. And there's just a lot of money there chasing the same deals and trying to you know, trying to get those deals, but it hasn't yet gotten to the point where they're chasing bad deals. And so far, that's a pretty good place to be in this market.
Thanks, Sam. Ron, what are you seeing in terms of real estate credit availability in structured markets, and how are private lenders filling the gap left by banks, and how long do you think that's going to last?
I think if you look at the private equity firms in the last 10 years and see how much they shifted from equity to debt, because now they're seeing so much in ability to structure transactions, to get secured cash flows, to get the upside, get really have control and full life view. And a lot of that comes down to asset-based lending. So, and also working with partners to be able to participate not just on the actual terms of the note, but also are there parallel benefits in terms of equity participation and preferential treatments in terms of other, you know, for example, there could be lending while, you know, data center, they're also representing the entity that is ultimately operating it. So we have been shifting from straight plain mortgage on residential housing on the type of properties you just talked about, have lended, you know, on $50 million, you know, single family. You know, that's where we started, but we found that the scalability was a lot bigger when you go into very new asset classes that are rising. As I highlighted, there's going to be, you know, while the existing manufacturing is hurting from these tariff issues, but we are seeing legislation that is opening up the space for American companies to license some of these prohibited countries to be able to resell. Give you an example, Ford Motors, you know, just signed up with Kettle, you know, for building a battery company in the US with the exact same technology that is prohibited to be here otherwise. So I think we need to think about real estate in different pockets, and each category of investor has their own interest. But private equity, private debt is really looking at very large institutional assets. Then behind it, there is a tech and a scale up involved. There is a renewability involved. There is a added value and 30-year utilization ahead, and cash flows that are potentially are very well secured from the tenant point of view. So I give you an example. The terms that were done for the Hudson Yard right around the corner, right around 2009-10, you would have thought that that's impossible to build a whole new, sub city within New York City, but everything ultimately was structured. The developer got their deal. The big pension funds and sovereign funds put their money in. They didn't get what they're really looking for at the end, but they're doing not so bad in general. So that's why I don't really want to make a generalization. You can go ahead and pick up a CMBS rate, look at a 2/3, 1/3, loan terms, they want a debt service coverage of 125. They want to, essentially not be more than 2/3 of the capital structure. That turns to be more of a street manufacturing of those. And I think the CMBS is used to be a decent exit for a lot of developers and real estate players, but execution of CMBS is not very creative. And wherever you have rating agencies, watch out. So you can't really. So if you're looking for really getting an upside return and getting double-digit return on the debt side with some security, I would direct you to look at the technology-based, whether it's data center, whether it's a battery manufacturing, whether it's a renewable, whether it's a solar. Those are the type. And if you really have a little bit of more guts, go consider emerging markets, because they're certainly getting done through leverage.
Great. Thank you. Thanks, Ron. JanetLee, DF Capital works closely with home builders and land developers. How do you see residential land and lot values holding up in 25, and where's capital still available?
Sure. So taking the second part of the question first, from the lens of DF Capital's business, where we are financing the horizontal land development for builder counterparties and our builder clients, and in return receiving contractual quarterly income until the last lot is sold to the builder. Broadly speaking, we see traditional banks really having pulled back from land development. And although in the last couple of years there have been new third-party entrants, it is still an exceedingly fragmented market, and one in which we see the home building need much greater than the capital available. And then on top of that, you see amongst the publicly traded builders, and those are publicly traded on the New York Stock Exchange, they are really leading the industry into what's known as asset light or off-balance sheet holding of lots. So that also is increasing the need. On the first part of the question, as far as lot prices, we are not seeing the same pace of acceleration of lot prices as we have in the last several years. And in fact, we see it really flat. On the finished lot phase, and to paint a picture in your mind of what this means, you have the raw land. Once you actually put in the roads, clear the trees, the utilities, et cetera, those are deemed in the industry finished lots. Those prices have been more sticky because just the development timeline has been much longer and there's a lack of supply.
Thank you. So Paul, from your position as CIO of a legacy urban real estate firm, how are you adjusting strategies in response to cap rate pressure and slower institutional capital flows?
First of all, we are investing for the next generation. So the thing is, cap rates themselves are somewhat inconsequential because we're looking for the next 30, 50 years and the investment. So as long as we look for location. For example, the family built the Grace building 75 years ago. I had land under that. They've refinanced it. And we'll keep on looking for assets similar to that so future generations can have their distributions.
Great. Eric, how are the fractional use of land, how has that changed the higher end real estate market?
Is this working? Yeah, it's working now.
Thanks.
Okay, we got it going now. There has been a shift again in the last 10 years. I'll just give you some working examples here. A lot of the branded luxury hotels, the Four Seasons, Auberge, Six Senses, Fairmont, Raffles, they're starting to sell branded residences as part of their hotel or an extension of their hotel. And the opportunities coming up now on the private residence side or the fractional side, because somebody that has the means and the capability to purchase a $9 million Four Seasons condo in Charleston, which has just been released and on market now, may not want to spend that. They may want to spend $1.5 million and have access to all those amenities and the city and so on. So you're starting to see a shift towards private resident clubs where it's on site, there's 8 private resident clubs out there now doing a bunch of different things, but very few of them are on site. And the hotels that are figuring it out now, the branded hotels and selling private resident clubs that are fractionally owned, maybe 6 weeks a year or 4 weeks a year, that's a major shift in trend in the last probably 6 to 7 years. On the land side, what I brought up before, fractionalizing a private island, I don't know if it's ever been done before. And we have the anchor of the legacy of a longstanding family office that's been in that market for over 200 years. So we'll find out pretty soon, but the initial kind of feedback that we're getting from corporations is very positive, but that's not the direction we're going. This is the first that we've released this structure was today to this group. So.
Great, thank you. Okay, so Ron, given your background in structured finance and private credit, where are you seeing the most attractive risk-adjusted returns for 2025, and what risks are being underpriced?
Thank you so much. Before I move on to mine, I've lived at branded properties, first Four Seasons in Boston, and now at the Mandarin here in New York for 30 years now. That's my entire career here. I started not being able to afford it, but then, made enough money by talking to the right people in the building. Now, thankfully, I can afford what I owe. So I just went, but it was not it was always attached to a hotel, and it was attached to, the Boston property didn't have anything other than the hotel and residences. When I actually purchased my own property in Time Warner Building, everybody at BlackRock started rolling their eyes that, we just hired a guy who's going to do credit, and why is he going nuts here? Well, they were wrong and I was right. And that same exact deal in a CMBS did not get the right attention because, the guys who were actually doing the underwriting did not have any idea what this meant, right? They didn't know, retail, hotel in New York in a closed space, how is that going to succeed? So anyway, just want to make sure that that innovation in real estate is coming and it's not going to go away, and rebranding, restructuring is coming in. In terms of our focus today, where we're focused is along the same lines that mentioned, we're finding huge demand for private islands, whether it's in the form that you're looking at or in the form that is, they can easily be part of a bigger complex. I just came back from Vietnam. Two of the largest conglomerates, Sun Group and Vingroup, they have, if you guys saw these properties, you would just leave New York tomorrow morning and stay there for a long time. These are massive amount of real estate investments that are made over 10 years that the American or the institutional investor has been setting aside, not recognizing the potential of these phenomenally natured integrated properties are working for. These are now, they've come to a point where now they need to hand these to institutional and family offices because they've built it with corporate money. And frankly, state-owned bank money. So with that, these are ready to be transferred to private sector. Yeah, I'm definitely beating my own drum here, but I will be spending a lot of time to optimize the value of these assets going forward. I stayed in 3 properties that I would not be able to get anywhere near this quality of service here in US and anywhere else, frankly. And by that I mean, full attention service in terms of full amenities you couldn't believe that you could get anywhere in the world. So again, we tend to look into our own domains and we leave out 10, 20, 30% a year for over 30-year returns on the table. And that's okay. But these are for the bigger capitals. We see Warburg, Pincus was involved in the tourist sector in Vietnam sooner than anybody else. But you can count on your capital name will be at the top of the list. That's where I'm focused.
Great, thank you. JanetLee, DF Capital has a land bank model that sometimes involves seller financing or forward purchasing. How are you navigating risk in today's development capital structures?
So in today's really uncertain market, developers may not necessarily have an ability to provide builders with rolling takedowns, or otherwise known as taking lots down over time or providing that seller financing. What we see is currently appealing is mitigating this land development risk with really 2 key components when we're underwriting our deals. One is with builder parent level guarantees for the completion to complete that fully developed lot. And the second is to have a parent level CapEx guarantee. That's incredibly important for our fund. So going in at time of underwriting, we know what our max development spend will be, and the parent company is responsible for any cost overruns. As a fund, how are we navigating with it? We take a look at leverage as being cautious in really every market. We target around 40-50% leverage on a target basis for the fund overall. And in 2023, when things got a little wonky, we even brought that down to 20% range. We want to always be in a position as a fund to be in control of our own destiny and not have to make decisions with leverage leading the decision, but rather being able to pay that off and run the fund as we see fit.
Great, thank you. Paul, is Swig Equity seeing more opportunities in debt versus equity right now? And how are you evaluating mezzanine or preferred equity positions in your capital stack?
Well, there's a lot more debt available than is equity. I mean, everyone's chasing equity and there's not enough equity around. The markets are just not there right now. With all uncertainty in the marketplace, equity is just much more difficult. It has been a long time.
Paul, can you talk about how the issue of equities on all the structures just failed today that succeeded in low interest rate environment?
Low interest rate environment? Yeah, the thing, most, the family, we have two parts of the firm. Is that one is we're a traditional real estate firm, and one is the family. The family has a very low LTV, which is 50. So we'll always, the family only goes 50-50. And on our investment, we'll go traditionally. But the thing is, at the end of the day, is that, we see more and more equity and debt. It's not from banks anymore. It's all from these equity funds, debt funds, mezz funds, preferred equity funds. I mean, today there's more preferred equity than equity. But, we have to be very, very careful on the preferred equity because they eat all the profits up. It sounds great that, someone will soon get a term sheet every day of the week on preferred equity. But on preferred equity, the minute they put their dollar in, that's when the clock starts ticking of their returns. And if there's a hiccup, like there could be any time in real estate, particularly now with the tariffs, we have a problem with shortage of materials possibly coming in. We don't know where we're going to be. So a preferred equity position in a real estate development today would be very difficult to underwrite for us.
Great, thank you. Sam, are you seeing an uptick in restructuring or recapitalizations across your client base, and how are family offices approaching distressed debt opportunities?
So there certainly is distress out there. There certainly is, and a couple of years ago, borrowers were borrowing short-term, low interest rates. Now their loans are coming due, and they're having difficulty refinancing. So there certainly is distress. There certainly is opportunities. But if you've been in this industry for a long time, as I have, and I go back to like the late 80s and early 90s when I started, and the RTC was taking over banks, and there was a wall of REOs owned by banks, and there was just companies were being formed just to buy REOs. I mean, there was massive opportunities in REOs. I think we have a much more efficient market now, and you're not seeing that, and you haven't really seen that for a while. Are there individual opportunities? Sure. But you're not seeing that, wall of REOs and just, low-hanging fruit and picking up all kinds of properties. I haven't seen that in a while, and I think, also lenders have gotten more sophisticated as it relates to, not foreclosing on the properties right away, giving borrowers time to work out deals and just sort of extending and pretending and hoping that the market will take you out of the deals. And they learned from when the REOs were like, there were tons of REOs and being sold to other companies, and 3 years later the properties were worth significantly more than they were when the lenders held them as REOs. So lenders have become more patient over the decades, I'll say, and that's a good thing for everybody. I think where we are right now in the market, I think you're starting to see cracks in the extend and pretend loan extensions. The CMBS lenders are looking at all the private credit that's, the liquidity that's sloshing around, and they're, pressuring their borrowers who are, you're starting to see them pressure the borrowers to refinance from other sources, and so you're starting to see that. Where are the opportunities now for everyone, really, home offices in particular? It's the same opportunities that the private equity is looking at, like, for example, recapitalizations. If there's a distressed property, but it's a good property, it's a good borrower, and it just needs more funds to accomplish something, that's where I see, the private equity and the home offices try and get into those kind of deals. It's not like there's a ton of those going around, because a lot of times the problem is really as a result of interest rates, but there are some of them. I'm also seeing, unique opportunities, like, like, for example, there's an asset class in New York, offices that are on, let's say, in the 30s on the West Side that, nobody wants to touch. It's mid-block. But then you see some people that, have office buildings around that area, and the prices are so depressed, you start to see a little bit of nibbling into buying some of those assets. Not a lot. I mean, there's not a lot of that going on, but the opportunities in the distressed arena are either individual opportunities or in recaps and or preferred equity. I'm seeing folks do preferred equity as well, and that's what I'm seeing.
Thanks. Eric,
On construction projects, what length of time is there, and what a percentage is being pre-sold? And what length of time does it take to finalize the complete selling of the project, to begin to generate the returns? Are you seeing, given this market, an extension of that and more difficult, it takes more time to generate, because that's going to affect your returns?
Yeah, I am. I mean, I'm seeing a lot of, sort of interesting things that people are doing that are different than what I've sort of seen in the past. I'll give you one example, right? I'm working on a deal now where there's, a bridge loan. We're negotiating a bridge loan, but at the same time, we're negotiating the construction loan. And the construction loan is going to sort of sit out there for a year and a half until we actually start constructing the project. And then it has the potential to go out in total of 5 years. And so, you're seeing, if you want to do construction loans both on the lender and on the borrower side, the developer side, you're seeing folks be creative. And I think one of the things when you have private credit, as opposed to when you have a bank, a life insurance company, or CMBS, you have both in the structuring of deals, and also when deals turn and go into distress, you're seeing a lot more creative structures, and a lot of them are just one-offs.
Thanks. Eric, do restructurings or recaps, is that happening in the high end there that you're working on? Or
No, we're just a little bit different animal here, coming at it from a different direction. But I do find it interesting that, our capital partners on some of our larger projects are Baupost and Wheelock Street Capital. Those are our two kind of financial backers. I'll give you two case studies. One, we took a project over in Fredericksburg, Texas, 2,000-acre development, was owned by Hal Sutton. Anyone know who Hal Sutton is? A world-renowned golfer, captain of the Ryder Cup team, has never developed anything before in his life, but he was developing a project in Fredericksburg, Texas. Lehman Brothers foreclosed on him in 2008, and then it sat in bankruptcy status until 2016. So Texans, to my fellow Texans that are listening to this call, they're a different bird altogether. They have multiple houses in the same state of Texas. Texans will have 3 and 4 houses in the state of Texas. One's at Port A, another one in Houston, Dallas, or Austin. They'll have a ranch that's been part of their family for generations, and then they'll have a place in the Texas Hill Country. So that's a little bit different structure. We went in there and we follow a process where we're dealing with husband and wife directly. We don't have builder programs where builders are taking down our lots. We don't have lot allocations towards builders. We're selling the lots directly to husband and wife. And then if they do find, they're buying that with cash almost 90% of the time, 95% of the time. The lots in Texas went from 600,000 to 5 million, the dirt. And then the home construction was about 800, 900 a foot. So they would get a loan and a construction loan for the construction side of things. In Charleston, we did one Vendu range, and that was a partnership with East West Partners. And we tripled the cost of all the square foot of condominiums that's ever been done in the city of Charleston in 2000. So the majority of our programs are pre-sold. So when we do have a financial backer, it's usually for the acquisition of the land. And in most of our projects, there hasn't been a cash call, from that capital partner through the life of the project.
Thank you. Thanks. So JanetLee, how does DF Capital position itself within a family office portfolio? Are your funds complementary to core real estate or substitutes for direct development exposure?
So in a word, yes. We do look at ourselves as a complement to core real estate in a family office portfolio, and depending on risk tolerance, could be also a substitute for direct investing. However, we really differentiate ourselves through our structure, and I think also in 3 core ways. I know a lot of people are familiar with real estate funds being 10 years. We have 5-year fund duration, and importantly, we target distributions throughout the life of the fund. And then the third key piece is really, it's an interesting take where it's asset-backed finance. We own the land and it's contractual income. And in that way, it is fixed income and credit-like. And what that has translated into for us is Fund 1 fully net realized at 22%, and we target all our funds at upper teens return.
Over how many years?
5 years.
Great. Thank you.
Thank you.
Paul, what property types or geographic markets are most attractive to your team at this point in the cycle? And are you adjusting allocations across office, multifamily, industrial, or what do you do?
We only do 2 asset classes, which is office, commercial office, and multifamily. We're very bullish on office, both in New York City and San Francisco. Also LA, we've made some recent acquisitions in San Francisco and LA.
Okay.
It's a great time to buy. It's an opportunity.
Any of the mid block in the West 30s?
No. It's a great place to land bank because the properties are so low. If you can get majority of the block, you're absolutely right. But the thing is, it's getting the full half blocks on the corner, so you're not landlocked. Because all those buildings are just obsolete.
Yes, yeah.
And that's where the problem is. Oh, that's where the opportunity is.
Yeah.
Yeah.
You have to be willing to sort of wait around.
Yeah, yeah,
Because it's
yeah.
not, it hasn't turned yet. and
No,
The opportunity
no.
isn't here yet.
Great, thanks. So 10 minutes, great. Eric, how, Merlot and asset allocation, is this really lifestyle or is that like, how do you see it as
The asset allocation for the individual or the asset allocation
where,
from
where
the-
you would, where Merlot would fit in, or is that more, how would you look at that? Is that,
Oh, from Merlot's perspective, we're mostly on the development and the real estate sales and marketing side. We're not on the cap stack. We're not, we typically will fund projects along with our development partners to a certain extent, but a lot of ours is earned through pre-sale.
got it? Thanks.
Eric, are you a co-developer or is it purely a fee-based?
It really depends. I mean, in most
You know, for
projects.
film, The Island, for example.
Oh, no, I'm a joint venture partner with the
Okay.
family. I am truly a joint venture partner with them.
And what about the hurricane and stuff like that on an island? I can't, you've got a hurricane and insurance on an island.
Mhm.
How are we overcoming that?
I mean, it's part of life. I mean,
Yeah, but particularly when families are there, entire families there, and there's hurricanes and there are issues, we see them more and more as the global warming is happening.
right.
And it's concern for families that they're there, the entire family. I mean, luxury is having the privacy. Which
Yes.
is an island.
Yes.
But the thing is, the entire family's there, and there is a hurricane or there is an issue.
Well, the good news about hurricanes, and I've worked on multiple projects in the Carolinas and in Florida, you get significant advance notice to get out.
Yeah, but
It's typically a 72-hour notice, and if you just don't heed those warnings, then shame on you. I mean, we'll clearly, I mean, the family is based out of that area that I'm partnering with. So when they clear out, they're clearing everybody out, and they own significant amount of assets in the Florida Keys as well. So there's an action plan to get families off the island in case of, bad weather. I can't put that on my marketing material, but yes. Yes. Yeah.
It's really ultimately comes down to not hurricane, but essentially someday the island be underwater. I mean, and that can be predicted between 10 to 20 or 30 years, depending on whose numbers. But you can engineer around that if, hurricane and frankly, rise of water, as long as I don't know how much investment you are making physically, but today's technology to avoid and resist these kind of natural phenomena is there. You just have to put in the right money into it.
yeah, but that's cost millions and millions of dollars to do that.
Not necessarily, it just means pre-thinking. If you elevate and you actually, if you look at some of these patterns of hurricane, I show you some hurricane pictures and even fire. One home stood and everything else around it was not there. So in terms of hurricane, it's actually, if you create what is called a vacuum underneath the building, so effectively hurricane goes underneath and in Gulf of
So
Mexico,
the
of
building's built on stilts.
course.
Yeah, yeah, yeah.
That's investment.
Yeah.
So, well, I'm from California. We did the hangar built, we were built right in the middle of it.
Well, it's
you
like
know,
go to
the most-
Charleston now.
I'm
or
sorry?
We go to Charleston, everything's built on stilts.
Yeah,
Yeah, near the water, yeah. Yeah.
Yeah. Yeah.
None of it's real, it's all been created and everything's been.
If you start fresh, you can deal with it. If you have a home that's been there 30, 40 years, was built without really thinking about these things. Yes, but the new construction is so efficient, you wouldn't believe it. And you can even make it fire resistant, hurricane resistant, and water surface rise. All you do is, think of people building homes in Venice. That was how many years ago, right? As human beings in engineering, we can handle this. But the reason they built it is because they were being attacked on land. They said, how do I get away from the guys who are coming at us? So they have effectively mitigated one risk against another, right? And that's all it is. They need privacy, they have to accept it. But then there are other parts of the world that are a little bit safer, but farther. They don't have the benefit of, hopping into, Miami or Palm Beach.
Can we spend the last 10 minutes talking about New York, the good, the bad, and the falling knives? Is that possible?
Is
I
there
will
such thing as
never
fall,
leave
is
New
there such a thing as a falling knife in New York? New York's doing extremely well, better than most of the country as far as offices and as residential. The Class A office buildings are 100% leased. Class B office buildings are now becoming leased. We're having problems with C and C minus and the ones in between 5th and 6th Avenue. But New York is looking very, very bright as far as commercial office spaces are concerned. Residentially, condos getting record numbers all over the city. On the lower level, that's luxury. So I'm with you right there on luxury. And luxury in New York is $4 million and above. Where we've seen the problems is $4 million and below. These people are relying on mortgages, and the mortgage rates are so high, they do the calculation between a rent and a purchase. And today, the scale is still to rent, but we see more and more people coming into the market because they're going to lose the opportunity once the market changes. But I think New York is on pulse. More and more people are coming to the office every single day. I mean, you go to Grand Central at 8:30, 8 o'clock, it is just the same as pre-COVID.
You're bullish.
Exactly.
I was at 111 57th, right? That's a building that had the issue during the hurricane, right? They went bankrupt. It's owned by one of the Apollo as a big investor. I was shocked when I was in that building in their private club and their residents. The amount of money they've recently put in this individual units, they're over 10,000 per square foot. And it's hard to get one if you want one. So when you're looking at $200-300 million, $100 million homes, you think those would be tough to move. And we came from essentially super jumbo mortgage lending. We used to think 50 is really the limit. Now, 200-300 million valuation, and they really sell because if you have 2 or 3 celebrities in the building, that entice everybody else to jump in. All they do is they show up on a Friday, happy hour, and say hello. I remember Richard Branson coming to his property in La Residencia. That was 26 years ago. He really made the millionaire row to a billionaire row within matters of 5-10 years. That's how he made riches. So I don't think on a luxury side, there seems to be no limit. And New York will have more of it. And, again, I'm one of the first person to bet on it. So I'm okay with that.
Sam, JanetLee, New York City, thoughts on what's going on or no?
I think it always remains the heart of business and of energy. And I think everybody keeps going back to it. And I think people have been surprised at how quickly it bounced back from COVID. And to your points,
Historically, New York has always been the last to go and the first to come back. Case in point right now.
And another factor that's just preventing sales under the $4 million where you need a mortgage is the fact that, the people who are selling also need mortgages and they're not, getting rid of their, 2.5% mortgages. So they're staying put. So that's another thing that's affecting it.
Yeah, you're going to find that inventory is going to be low. Sooner or later, in the next 18 months, inventory is going to be very, very low. So the price will go up. Right now, prices are flat in that $4 million and under. Simply because a lot of people have their 2 and 3% mortgages. There's no reason for them to move. But
Right.
sooner or later, it's going to start calculating and the price is going to
I
go
mean,
up.
there's a little movement because, people can't, not everybody can hold on forever. Sometimes their jobs move to a different location, sometimes other things happen. So there is some movement, but, I think the financing is just
But
holding
we're
it.
also seeing a lot of people moving back into the city.
Yes.
And a lot of people, the snowbirds are coming back and they want to have the lifestyle over again.
Right.
That's very much part of what's happening in New York right now with sales.
What are you basing your comment on that you think interest rates are going to be lower in the coming months?
Well,
Because,
we're hoping that interest rates will be lower sooner or later.
say it again?
But say we're looking at the administration for the interest rates to be lower sooner or later.
But
There's
depends
no
on, it
fact- there's
depends
no-
on,
there's
it
no
depends
fact that
on,
the
it
interest rates
depends
are
on
gonna-
how the economy functions. If the economy grows, the Fed isn't going to be able to lower interest rates.
So, real estate is the moment, is an issue with that.
Well,
I'll-
I'm just
I'll-
asking, I mean to. I think interest rates are going to remain high depending on the economic conditions of growth, potential rental.
No, I agree with you. I mean, the thing is that it is an issue when we have high interest rates. A lot of people can't afford the payments for a mortgage. They're paying ridiculous amount of money for rent. And then the tilt is to be what's less expensive to purchase or to rent. We're getting close.
Okay, thank you.
Any other questions from the audience?
Loud
enough? Okay.
What, if any, effect do you feel if, calm down?
I think we have a problem. But the problem being is that the very people is trying to help is not going to help. Because the landlords in these buildings can't afford to keep the buildings up. And that's where the big issue is. It's great, it's going to give frozen rents for 2 or 3 years. But is the city going to freeze, real estate taxes on operating? If a landlord can't pay his mortgage, he can't afford to have that tenant have a new refrigerator. So the very people they're trying to help, they actually hurt. And that's the problem with rent regulation.
So, the second part of that question is, do you feel that there will be those that somebody just mentioned coming back into the city, that they will again turn around and say, this is not the city that I want to be?
Yeah, New York is resilient. And it's going to find its own way. The thing is, we're not talking Midtown Manhattan, Upper East Side, Upper West Side. We're talking about on the rent stabilization and the freezing of rents in other areas of the city.
And it's actually already happening in the rent stabilized market where landlord, when tenants move out, landlords are warehousing apartments. Because it just doesn't pay for them to put the money in to fix the apartment because their ability to get that money back, the rents have already been dramatically decreased. So once you tell these same landlords that they can't raise their rent for several years, what's that? That'll just exacerbate a problem that already exists.
Can I give a story on the rent issue? I am a mentor to a very sharp young woman who happened to be involved in the art and fashion industry, and their parents are in Dubai and they're Canadians originally. In order for her to rent, she had to show up with a $400,000 revenue income documented before they would let her rent. So if it was a tough environment, they would not be asking for it. So right now it's hard to get the renters out of the units. The more legislation you pass to try to make it hard for the landlords to deal with the renters, all you're making is less available to the real needy people who need it. They just have to go out of New York. In addition to that, I want to make sure every September you have a very large population of foreign students and others coming from, other schools doing an MBAs at Columbia and at NYU. Every one of those are a candidate to buy a unit or rent a unit for a long term. So every year we get a new supply. Every time you get a doctor moving into New York City to work for one of these research institutes, you get another candidate. So the dynamic of New York, every time Google move an executive here, every time BlackRock brings somebody from London here, that supply of demand will continue. I have seen it over the last 30 years. All it is grown bigger and bigger. So that's my take. That don't look. There are a lot of financial entertainers. They like to scare you. They only get somewhere by being scaring you, but you need to use your guts. You need to understand your feel for what city you live. I think that New York is the greatest city in the world, and I think it will continue attracting young, talented people here.
All right, so parting thoughts from the other four, 1 minute each.
So I agree, in my in the history of me being in New York, which I've been my entire life, when everyone counts New York down and out, it always comes back. Now, I also lived through, the 80s and the late 70s and early 90s in New York, and it did take a long time. And, sometimes it does take a long time. And, it would be good if we had a lot of, if our government was actually, trying to make things a bit better in New York. And hopefully that's the way it would go.
Well, my connection to New York is all personal. Born and raised on Long Island, Chaminade guy. Daughter went to Columbia. Grandparents came from Tipperary and Awfully to 248 Sherman Avenue, and they were up there in a rent-controlled apartment for 50 years. So there's my connection to New York. That's all. That's my input.
You're underpaid rent.
Yeah.
Oh, my comment will be anybody that knows me knows how much I love New York. I was here for a long period of time and never thought I would move. And my joke is that I am the statistic. So I am the person that was on Wall Street and then moved to Florida during COVID temporarily and then ended up not moving back. So I was thrilled to see how resilient New York was, and the energy is just as alive as it ever has been, although it was shocking to see it move to kind of a Tuesday, Wednesday, Thursday city, right? With more people out of office and still working from home Mondays and Fridays, although that's, I guess, shifting a little bit still. But where we are now in Florida, and our investments are in the high population areas where people are still moving to Florida and Texas and kind of mid-Atlantic areas. So that's where I focus now.
I'm for affordable housing. We're all clogs in the wheel in New York. There are people like us, and there are people in the service industry. The people service us every single day, and they have the right to be able to live in a nice apartment. The question is, how do we get there? And the way we're doing it right now is not working. Simply, private landlords can't afford to give these people what they need. There has to be a system that works for everyone.
Great job, guys. Thanks so much.